Hey traders, Todd Gordon here with TradingAnalysis.com. This is for CNBC's Trading Nation. Traders, if you've been watching our videos here on Trading Nation, you'll know we have just sold the SPY, so perhaps watch the last video. Now we're going to go to work on a massive underperformer in the NASDAQ, which is Facebook. Facebook has been a laggard on this recovery rally that we've seen here in the NASDAQ. And as you take a look at the chart, you can see this exactly what I'm referring to. The yellow is the NASDAQ. This is the QQQ, the ETF that tracks the NASDAQ. And you can see that we've made a pretty sharp recovery here that has exceeded this early February high in the yellow, which again is the NASDAQ. Notice Facebook has not done so, has not recaptured that early February high. So we have a pretty good divergence here. Further, there was news that Soros sold upwards of 500,000 shares in the second half of 2017 and the latest SEC filings. So you've got Soros adding some supply to the market. I believe this recovery rally in the market is sellable, and with an underperformer like Facebook, it's time to go to work. Now, let's use our Fibonacci retracements to figure out how much of the loss from January high has been recaptured. And we're just going to click the beginning of the sell-off down to the end. And as we zoom in here, you can see we've just fallen short of the half back or the 50% retracement. Again, which one of these levels do you know, or can you anticipate ahead of time that will hold the reversal? You can't tell. But what I particularly like about this is this little three-wave pattern, which is called a two-step pattern. Okay, so we go up, we sell off to a higher low, and then we make a new high. This is a very common corrective structure that does happen when you have a move that is trading counter to the trend, which I believe is now down. So the trade I'm looking to do here is to be short Facebook. Now, we always want to define the point at which we're wrong. We got to find our uncle point. Where is our thesis for being the trade? Where's that wrong? I always like to use the last Fibonacci retracement up here, which is going to be about $189. So let's go ahead and say whatever trade that we're putting on in the options market, our line in the sand, our stop loss is 189.50. Above that, get out. We're wrong. Contain the risk. Otherwise, here's what we're looking to do in Facebook. We're going to be going out to the March monthly options. We're going to be buying the $175 put. We're going to be selling the $170 put. We're going to be buying or paying for this $5 wide spread. We're going to be paying $1.45 or $145 per option spread you're trading. That is the max risk. That is the max loss if everything goes completely wrong in this trade. You stand to make upwards of about $355 if the trade goes perfectly according to plan. Okay, so let's go ahead. We're going to have to pay about $1.45. I'm putting that trade in, and that trade is now working. Remember, we have the stop loss back up on the chart about 189.5. Above that, get out of the trade, recover any premium they have left on that option spread, and simply move on. Otherwise, it looks like Facebook should begin to go down, retest the lows at about 167, and possibly move back into the $150 region. So Facebook is looking set to break to new lows. Be sure to follow us at Trading Nation on Twitter for updates to this trade, as well as all the other markets our traders are watching, and we'll see you guys in the next video update.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.